Okay, I think we can start off. So again, thank you everyone for joining us today on a Saturday morning. Uh, okay, to start off with the title, right? It's what does it say? Measure, analyze, and respond. Usually, our first reaction, or rather, that is something that we do it without going through the first 2 points, right? We don't measure and analyze and then respond. It's usually immediate, right? Our response is usually immediate in any case, not just investing, right? In investing, it becomes all the more easy today because execution has become very, very easy today. Our typical uh, reaction is very immediate. It doesn't go through measuring, analyzing, and then this leads to response. This doesn't work that way. It's pretty immediate. So that is simply what we are going to talk about and how Solitaire does it differently. That's what we are going to talk about in this presentation. The part one, which is measure. So in investing, in the common parlance, what we mean by measure. In India, it is the opportunity that we need to measure today. It is the big picture that we need to be looking at today before we move on to our investment framework and how we respond to what our analysis tells us. So moving on to the first slide, which is India, the big picture. See, what you can see from this slide is that India is firing on all cylinders, right? Be it G20, be it space, be it digital revolution, be it the way we are tackling our financial markets, and overall, with respect to FASTag, Paytm, I mean, across different cylinders we've been firing, right? So that is so everything is working out towards India's favor today because demographically we are placed in a little bit of an advantage over our contemporaries. But then it is important how we execute today. See, now the next 10 to 15 years is going to be really, really important for us as a nation, both economically, financially, and diplomatically, right? It is also the relations that we build with our neighbors and our peers in the global setup that takes us where we are. I mean, that has taken us where we are today and will take us forward in the future as well. So if you look at even the World Cup or the Asian Games recently, I think it comes with a sense of achievement in other areas that translates into sports as well, right? I think a good attribution of our recent performance in the sports arena is because we've been firing on other cylinders as well. It gives you a sense of achievement, and as a nation, you want to do more and you want to grow better. So moving on to the first slide, what drives this, right? We have a few data points which actually tells you what makes India a great nation today and what will make it a bigger nation tomorrow. A large and young population, right? So if you look at India's population today, we are much, much better placed than our peers. Whether it's going to be Japan or South Korea or China or Thailand, it's our demographic dividend that is going to be paying off through our young population. That's going to get paid off through our young population is huge. So your growth, you have a young population which is working for you, and there is a lot of time, or rather, the capturing of the human capital, right? Because of our young population today, it's going to be very, very the longevity is going to be very long, right? There's going to be a good amount of time that your working age population are going to work towards the betterment of the country, and that puts us at a much bigger step than our peers today. So if you look at the largest contributor to world's working population by 2020, 2031, it's going to be India. So at that point of time, we will probably be a much bigger superpower than we envisage today, because that is something people have actually always gotten wrong, right? We've always tried to put India in one place, but India has always surpassed those levels. I think that is what is going to happen in 2031 as well. I think it's going to be a very, very interesting period with our current working age population being the highest amongst our peers. And the fun is for all of us to watch. And the rise of the middle class in any economy, right? It's the middle class which will, or the rise or the improvement in life of the middle class that will ideally push the economy up. So that is something that we are noticing a lot today in India. So by FY47, we believe that, or rather, the projections say that the weighted mean income of a middle class family would be around 49.7 lakhs. So that's not something which can be and it's a steady growth, right? If we do the right things, if we execute on at the right levels, if we place our capital in the right places, and if we maintain our existing diplomatic relations, I think we're there. And this is to give you a sense of how the industries have grown over a decade. In Solitaire, as such, we are very positive on the MC business, demat. So the following other industries as well, demat accounts or NSE cash turnover, it's all a big bet on the capital markets, right? So the top three, if you look at, they're all a big bet on the capital markets. So if you look at the overall world average, it's around 70%, right? So if you look at MF AUM as a GDP, as a percent of the GDP of India today, it is around 16%. So what you can see is there's a huge leeway for growth in the next 10 to 15 years. And look at how we've grown from 2003. See, in 2003, it's around 1,21,000 crores, which was the overall AMC business, overall AMC industries AUM, while we are at 46 lakh crores today. I mean, that's such an explosive growth that we are seeing, and the interest that the retail has today in the capital market has also gone up multifold. So what you can see is there's a lot of growth, but still we are at a very small position when you compare it to the world. So when we compare it, we obviously compare ourselves to China. So if you look at other sectors like, let's say, cement production or steel production or aviation, you can see that we are moving that way. If you look at our per capita consumption in cement, we are around 250 kgs, where China is already at 1,000 to 1,500 kgs. And when the world itself is expanding by itself, the overall market itself is expanding, overall global market itself is expanding, and our per capita consumption is about 1/6 of what China currently is. You can see that the leeway of growth is and the scope and the leeway of for growth is so huge that we still have a long way to go. And it is upon us today to make sure, and we have everything coming right at all at once. See, this doesn't happen every now and then, right? So this young population coming together, your middle class rising in terms of lifestyles and the way they spend and the way they live their lives, and this per capita consumption gap and the leeway for growth, all this happening at once, this is going to be a beautiful period for India. So there is no doubt about it, right? It's totally, so we might have some short-term hiccups, right, as any economy would have, but over the long term, India is poised at a great stage, and that is simply what this chart shows you. And you can see this is actually a very interesting set of data. If you can look at the first column, that is country and the 1990s, right? If you look at how where India and China are placed in 1990, they were nowhere, right? They were nowhere in the top 10. But if you look at 2000, China has made it to 6. And 2010, China has made it to 2nd, and India has come in now at 9th. Now you can see how many steps India has been moved up from 2010 to 2022. It has moved up from 9 to 5, and now we are at 3, or rather 2028. We are close to 3 today, and by 2028 it will definitely be at 3. So what this tells you is, see, we've been continuously making strides in terms of development and growth. And with respect to GDP growth, it's something which is visible, right? It is something which is tangible in nature. Though India was late into the party, and before which China had captured the entire set of between 2000 to 2022, this 20-year period, it is still not late for India, and there is still a lot of leeway for India to catch up with China in the next 10 to 15 years, and that exactly is what we should be expecting from India as long as the execution goes right. So part one is something that we took into account today. So we've measured how India as the big picture is going to help us in our investing today. See, all this contributes to one thing, right? If India grows, we grow, the corporate India will grow. And ultimately, if we are placed in the right areas, we also grow. So how do we make sure that we put ourselves in the right areas? We need to analyze, right? We need to analyze what our investment framework will be. We need to analyze what our philosophy is going to be, and if it is aligned with the growth expectations of India. So that's what we are going to talk about in part two, and how Solitaire fits into all this. The USP of Solitaire. We keep reiterating the same thing, that the USP of Solitaire stands at the customization that we offer on a portfolio level basis. So when we say portfolio level customization, what we exactly mean by that? Uh, when an investor comes in today, he or she is not going to get a portfolio which was curated 1 year or even 6 months back. It's going to be curated according to the date of entry of the investor. So our intention as capital allocators is to give a homogeneous experience to even the last client of ours. So it is the intention of the portfolio management team to ensure that the experience, investment experience, is homogeneous across a diverse set of clients. So which is why we do not want to churn the same portfolios again and again, because market context is something which is very dynamic. It keeps changing on a daily basis, right? So how can we control? We can't control the markets, but what can we control? Control the controllable would be customizing the portfolio according to the date of entry of each investor. So let's say you come in today, the way we curate your portfolio is going to be vastly different from what we did 6 months back or 1 year back. So just to give you a sense of what we did 6 months back, right, around March, at that point of time when the markets were a little lucrative in terms of valuations, we pretty much went to 70 to 80% within the first week, 70 to 80% deployment within the first week itself. Now it's come down to 40 to 50%. I don't think we are even close to 50% today. We should be somewhere between 40 to 45%. So what this tells you is we don't just blindly invest, and the customization is client level, right? When you get that kind of a customization, what you ensure is a reasonable homogeneous situation across a diverse set of clients. So we want all our clients to participate in all our ideas, but not at the same time. Obviously, it cannot be at the same time because of the date of entry, which is different across different portfolios. Now, coming to the businesses of the future. See, mostly markets follow, or rather, predominant investing follows liquidity or momentum, right? Our way of investing is vastly different from that. We invest into businesses of the future which will do well in the future. So today, if there is a business which is doing well, the probability is that it is already priced in. The market has already priced in all the positives of the businesses into it, and you probably are not buying it at the right price today to make sustainable wealth. So what we ensure is we ensure that we invest into businesses which will do well in the future, which are probably going through a temporary situation today, which will turn out to be temporary, or rather in hindsight, we will be able to say that it was temporary. Today, the market may think that these are all permanent conditions or permanent negatives, but that's when we as investment allocators come into the picture, right? So we know certain situations are not permanent, though the market terms it to be, or the overall market terms it to be. We know certain situations are temporary in nature. So we invest, and to that invest in those companies to our advantage during those temporary situations to make sure that we get in at the right price. And opportunistic buying. See, this is followed by opportunistic buying as well. So once we identify a business of the future, it is important to consider the opportunity before we go all in. So let's say we have an opportunity today. We don't, or rather, we are having an intended allocation of, let's say, 5% in a company, in a business, right? So what we ensure for the client is we don't buy it all at once today, unless the price is very lucrative, right? Today, and obviously we can't predict where the prices will go tomorrow, because that's more of a factor of demand and supply. What we can do from our end is focus on valuation. So if valuations are fair or a little bit soft, we can go to a higher allocation today. However, if it's a little bit uncomfortable, we start off by having a very small tracking position, and then building it as the opportunities come. If opportunities don't come, we are not in any hurry, because we believe opportunities will keep coming in the market. It is up to us to have a strong vigil on prices and fundamental performance before buying all in, right? So that is something that we take care very, very closely, and we are very value conscious on that front. Low churn. The intention is to make sure that we hold on to our winners before they deliver what they are supposed to deliver to us as shareholders, right? Most of the time, what we tend to do is we start off with a position, we build a position into a portfolio. Most common investors do this, right? They build a position into a winning company. Once the company starts performing fundamentally, the market rewards it for its growth. And what happens is investors usually make some money. Let's say they double the money, and then they probably get out. it is usually not in our practice to sell our winners early, because it is we take an independent stance at that point of time to buy or sell, right? Because these two are separate decisions. When we have a low churn, when we have set our minds to a low churn strategy, we do not have the requirement to sell an idea to buy a new idea coming, which is coming in, right? We need to ensure that selling and buying are two independent decisions. So that's when you practice this low churn, right? When you practice this selling, which is being independent of buying, we always put our minds only towards valuations and the fundamental expectation from the company, whether earnings are going to expand, whether the multiples are going to expand, and when they actually meet, that's when your price explosion happens, right? And most of the time, we wait for the multiple expansion to happen and for the earnings expansion to. We don't really have the patience to wait for the earnings expansion to happen, which will ideally cause a price explosion. So that is where you miss out by having a high churn on your portfolio. But in Solitaire, we are determined to have a low churn and to ride our winners till the till as much value is extracted out of a specific company. And this is something that we follow our across our products, right? So a great investment is something which has one, two, three, four, five plus six, right? Which means you can get a company with good corporate governance. That's the first and foremost thing that we ensure, right? Because if the top, if things are not right at the top, then it's going to flow down till the bottom. And no matter what kind of numbers that you churn, no matter what kind of businesses that you are, no matter how much of a brand that you've built over a period of time, if you're not right at the top, then these are going to these are going to come tumbling down after a point of time. So what we ensure is we put this at the top. We put the top on the top, right? We ensure that good corporate governance is a prerequisite before we even consider a business which is worthy of buying. And that comes along with strong leadership teams as well. So when you have good corporate governance, it is not too it is pretty much a given that your leadership team also will have a good track record of execution. So when these are qualitative metrics, right? When corporate governance is of a pristine quality, you can pretty much be sure that your leadership team also will be of such quality. But then it's not always a given, right? But it's mostly a given, right? So we ensure qualitative factors like these two are set or rather are ticked off before we move on to the quantitative, which is industry leadership. So what you do with industry leadership is most of these companies or any company which is an industry leader today would have come to this position after going through multiple cycles in their respective industries, right? It's not like they woke up one day and then they suddenly became the leader of the industry. They would have gone through multiple cycles. They would have faced a lot of pressures in terms of competition, in terms of the overall macros not going towards their favor, all that, right? So they would have seen all these cycles, and that would have made them the industry leader today. So what you ensure by sticking with an industry leader today is that they stood the test of times and they know how to react to a specific situation when it comes to them once again. And high ROC. Ultimately, as shareholders, we are or rather we are what is it? We are slaves of ROCE, right? As capital allocators, our investors, we need ROCE to show up in the financials of a company for us to make money as investors, and that's obviously a given. And zero or low leverage. So what we ensure by having a zero or low leverage portfolio is that in times like these, when inflation is up, when interest rates are going up, and when the situation on the liquidity, there is a crunch on the liquidity front, there is a crunch. It is better to stay with companies which have a limited pressure on their balance sheet, which is why we stick to zero or low leverage companies. And it's hardly one or two companies in the Solitaire portfolio which will have debt today, primarily because their expectations on growth, or rather the way we believe that they would manage the debt, would be much superior, right? Only then we take a call into even a debt-laden company, or it's pretty much 80 to 85% zero or low leverage portfolio. Okay, so we've ticked off all this, right? One, two, three, four, and five. Though we've ticked off all this, it's not necessary that we definitely need to make money from a company which ticks off all this. It is important, it's extremely important for us to consider the valuations prevailing at that point of time when we invest before we buy a specific idea. Why? Because you can be the best company in India. You can have employees of pristine quality. You can have customers who want to work with you. You can have pricing power. You can have brand whatnot, right? But unless, as investors, we need to consider something apart from all that is what it is valuations, because markets are rarely in equilibrium, right? They either underpay or overpay, right? So we need to find, and this equilibrium spots or underpaying spots is what we need to be focused on before we get into a company, because it is very easy for a market to overpay because of the overall euphoria or of the overall liquidity coming into the system. So what we need to consider at that point of time is we should sit back, look at the company independently, not fall in love with a specific idea, and think if we it is reasonable for us to pay this kind of a multiple to a company at this level. It is going to be about sustainability in earnings. Today, let's say the company is earning or growing at 25%. How sustainable, how certain is it for it to grow at 25% for the next foreseeable period? You can see companies trading at 60 or 70 PEs, which again, let's say FMCG companies for that matter, right? If you look at FMCG companies, they demand those kind of valuations because of the certainty that they offer in terms of earnings growth. So even if there is certainty in earnings growth, and even if the earnings do come up, you will be in, you will be waiting for a price or a time correction to happen if your multiples contract. So even if you get into the best company in India, it is not going to be worthy of your time unless you get into the right price. Our process, right? Let's if you look at overall process, right? All this comes into what see, Solitaire or Vridhi or Sphere or Trueblue, which is the part of our overall PMS universe. This is something that we diligently do across our portfolios, right? Because if you look at reading annual reports, see, all this looks a little bit data heavy, but then this is something as capital allocators that we need to do day in and day out to ensure that we stick with the right kind of businesses, right? If you look at the first thing, right, which is this annual report reading and call transcripts. Mostly, if you look at annual reports, it's only a very small part of the portion of the annual report that we would need to focus on. But to ensure that we don't miss it, we need to go through the entire annual report just to ensure that we don't miss out on the important stuff. So it over a period of time, it becomes easy for you to spot it. But then today, with regulations coming in, with the disclosures changing, we need to keep ourselves updated with the process and the overall regulations before moving into the moving into the basic study of a company. So this comes along with studying the industry value chain or doing a primary research, right? And forensic accounting as well. So what we do is there's a lot of scuttlebutt that goes on with our smaller companies because you don't readily get the information that a bigger company will have in the public domain. So what we need to do as capital allocators is not just sit back and wait for the information to come to us. We need to look for the information. We need to find the information ourselves by going on the ground and on the field and getting it from the respective. See, because people will be willing to speak to you if you approach them the right way. I mean, whether it's going to be the management, it's going to be the vendor that is supporting the company, or customers that are with the company, or any other stakeholder of the company. It is heavily dependent on how you approach them and how you get what you need from them. See, this means that your work is not just restricted to looking at your computer. As analysts, our work is not restricted to looking at the computer or studying just annual reports. It's about going on the field and working as well, right? And this follows with a pattern recognition, because once you start tracking a business, right, you understand how the dynamics work, and over a period of time, you understand how the cycles or or the overall pattern works in the specific industry over a period of time. This gives you a sense of comfort when you actually invest into a specific leader in that respective industry, and you know how things are, or you have a fair idea of how things are going to turn out in the industry, because ultimately that is what you're going to do, right? That is what you're going to track. Ultimately, your price is going to follow your earnings and fundamentals. And what better way to understand or rather estimate fundamentals from a future point of view, unless you get to know about the business or the industry. And this comes to the judgment of the promoter or management. See, as we spoke in the previous slide, it's about good corporate governance and the qualitative factors, right? How do you judge a promoter? This is a question that our fund managers keep getting. how do you put this into paper, or how do you put this into Excel? So that's a very difficult thing to put it into Excel, or rather, you can't even put it into Excel. It's more like it's more about your experience in the fund management industry or your experience in the investment management industry that will tell you how can you judge a company's promoter. Because we've had in Solitaire itself, we've had companies which have had managements which said one thing and did another thing, right? So what do you learn from those managements? It's that today they might be saying something. If it's a very over ambitious management that gives you lofty targets today, and if they don't meet it tomorrow, what is the point of speaking to them, or what is the point of doing all the work, right? Ultimately that builds over a period of time. But then that is the process, right? You'll have to go through the process. You might be going through all this, and you might have spent hours in doing all the top ones, and then once the management doesn't deliver, or if the management doesn't deliver, it's all going to go waste. Or it looks like it's going to go waste. No, but then all this is going to contribute in some way or the other in the form of another opportunity. That is how we would take it. And the time horizon, obviously, right? It is to look beyond the immediate quarters. So this is where I think we as investment allocators have a big edge, right? Because mostly, typically, any participant, market participant, would be okay with staying invested for a period of maybe 1 to 2 years, or even lesser today, right? That is what we are seeing today. So what happens is you have a huge period for you to make your investments, or scale up your investments, and it gives you a competitive advantage, or rather, it gives you a an advantage over the others, over the other market participants, because you're willing to wait, because you're looking beyond immediate quarters. You're looking for a period of at least 3 to 5 years. And how to do all this is going to be process, 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 right? It's completely a checklist driven approach. You keep doing your process, reiterating the process, making your process better, and putting in more efficient, robust functions in the process, and you drive yourself towards a checklist driven approach, and you're there, right? This is something that we keep doing again and again and again. And obviously, the learning curve is going to reward us in a big way if we keep doing us the same thing again and again as capital allocators. And that is something that we've been doing for a pretty long period of time to ensure that it is done for a large set of investors. For investors at large, right? The portfolio of, okay, now we've understood how the process works, how the philosophy works. How does Solitaire's portfolio look today, right? As we spoke about market leadership, it's a very, very important aspect in a company that we need to, or at least Solitaire ensures, right? So if you look at the top three companies in any industries, in any industry, they take a huge share. They'll probably take away 50 to 60% of the industry profits. So let's say there are 100 companies in an industry, the 97 companies would take away probably 30 to 40%, and the top three take away 60% of the overall industry profit. So what this tells you is it's simple, right? It's like Pareto analysis. The top three takes away huge chunks of the overall pie, while the rest have to fight for the smaller pieces. So what we ensure as capital allocators by staying in these companies is we ensure that again these companies are they would have reached their market leadership after a good period of time. So they would know what to do when the situation doesn't turn in their favor. And that's where we need to be, because all is good when things are good, right? Everyone, when the money rain pours, everyone will want to get drenched. But then when it stops, right? When the party stops, that is something that we need to ensure that we need to be with people who know how to react when the party stops. So that is where we position ourselves, and that is where our balance sheet, or rather Solitaire's balance sheet, also looks. So if you look at Solitaire's balance sheet against the BSE 500 index's balance sheet, right? Around 17% of our Solitaire company, or rather around 17% of the overall portfolio of Solitaire only carries debt, whereas it's 50%, which is half of the portfolio in terms of the index, which carries debt. So what we ensure is in times like these, when turbulent times like these come into the picture, and when the overall situation on overall liquidity, there is a crunch, we believe that staying with these companies, or we've seen that staying with these companies makes you better off in terms of capital protection. And these companies are companies which have very strong balance sheets. They are very self-sustainable in nature. They don't rely on external borrowings to fund their future. So these are the companies we typically stay with. Okay, this is something that we've repeatedly spoken about, and how drawdowns work against the index, right? It's not like Solitaire doesn't fall, or Solitaire will rise up when the overall index or the broader index falls. When capitulation happens, it happens across different indices. It happens across the market, right? Everyone will go through a period of capitulation, and but it is dependent. So once the liquidity situation is good, everyone goes up. When the liquidity situation is bad, everyone comes down. But then when the liquidity situation becomes normal, right, it stays at an equilibrium, which companies come back are those companies which have a good quality, right, which ensure that they can bounce back even in times of uh, even in equilibrium kind of times, right? With the liquidity situation going bad, it's these companies fall down also. But then how far do they fall down, and how faster they can get back up is the question. So if you look at Solitaire, when the BSE 500 fell down by 18%, Solitaire fell down probably by 11%, right? This is something that we keep telling our investors, right? When your portfolio falls, you don't need to worry. We are all buying sound companies for you. We are all buying companies that can bounce back once the situation turns better. But then there are certain companies in the index which may not turn back. So you are not always you're not always going to compare the situation with the index when the liquidity situation is good. But certain companies can just go because their rally might be liquidity fueled. So this has happened once again in during March 2023, when the BSE 500 index fell down by 11%, Solitaire fell down by 7%. So intention of Solitaire is to capture, or rather ensure, that the beta is lower when the market falls, and the alpha is better when the market goes up. So once we ensure, or rather, typically our portfolios are curated in a way which they have behaved that way. We don't intend to put this behavior into numbers, because we didn't expect, or rather we didn't have any specific analysis to say that, if the market falls by 20%, we should fall by 10% only. It's just our curation. It is just the companies that we hold, and the way we invest, and the way we deploy money, that has ensured that this outperformance, even during times of downturn, has ensured that Solitaire is at its place where it is today. In the part three, how we respond to all this, right? So we've seen the big picture. We have this measure today. We have measured that India is a great country. It is making strides across different industries. It is poised for growth in the next decade, all that. And we know how Solitaire as a product has a very, very strong investment framework. So how do we actually respond to this? How do we put this as a value enhancement to our investors? That's something that we would like to talk about today. If you look at stock level value enhancement, we have taken examples of four different scenarios of stocks in our portfolio, which have had multiple. So an investor would have had multiple different experiences with each of these stocks if they had invested with us at that point of time. So if you look at the first company, which is an IT company, which is an all-star, right? So everything was going well for this company. We bought this company in 2022 August, and fundamentals were good. Stock price was also good. So it doubled since our initial buy, which is close to 1.5, or rather, even before 1 year, it actually doubled, right? So these kind of companies are very rare to come by, and this is done. And this IT company has done this when the overall IT industry has not done so great, right, in the last 1.5 years. So what this tells you is we are extremely bottom up in our approach, and these kind of companies, it just takes a strong vigil from the investor's point of view, or the capital allocator's point of view, to ensure that even in a very slow moving industry, or rather which is not expecting a great it's not expecting great growth prospects in the medium term, can still have a gem like this, which will still deliver great alpha over the entire pack. So that is something which we would find very rarely, this kind of things happening, because a lot of things have fueled this, obviously, right? This IT company, which is an all-star, everything came into picture and everything worked out well. But let us look at the second quadrant, which is an industrial consumables company. We first bought this company in 2019, and since then, the management has been positive on the business. We've been positive on the business, and everything has been going on well, right? But then what happened was it was not reflecting on the stock price for some reason. It was probably because the markets did not did not believe that the business could deliver, because this company rarely came out to the public domain and spoke about what it's going to do, but it was still working in the back end. So that's when we realized that as investors, it's up to us to get the information that we need, because certain managements don't talk. It's up to us, the way we approach them, the way we understand what the business prospects are going to look like in the foreseeable future. That will get us information. So we were patient. So we knew that this is going to get rewarded in the long term. Let's wait it out. Let's make sure that even the last client of ours, we are able to buy the stock, and we kept buying, right? And we were very value conscious on price as well. Even if there was a short term up move, we were not too excited to buy it right then. We were very slow. We waited for the right opportunity. We bought a good amount for our clients. And if you look at from 19 to 22, it didn't move up. In 1 year, it has actually moved up 3 times, right? So if you look at a 4-year period, it still translates to a 32% CAGR, which means that as long as your thesis is working out, as long as the fundamentals are delivering according to your thesis, the price is just going to be a function of when the market is going to look at these fundamentals improving and then reward it. So it is up to you as investors to see. I mean, because patience is definitely going to get rewarded, but not every patient person is going to be rewarded, right? It is up to the investor on, or rather, it is dependent on the thesis of the investor with which he can be, because our research was so strong that our conviction helped us stay within this company for a 4-year period, and that is what has been rewarded today. If you look at the third quadrant now, the general insurance company, which is currently an underdog, we first bought it in 2021. And since then, the fundamentals are being good, and the industry is not at a great place today. But then we believe that the general or the overall insurance industry is poised for a very long period of growth in a country like India. And you can see that it is currently an underdog, right? So this can go up into the second quadrant also. But then we as capital allocators, we need to track the fundamentals until then and stay put to ensure that we derive value out of this company as well for all our investors. So this is the third quadrant. Let's move on to the fourth quadrant, which we typically try to avoid. But then obviously, if you look at fund management, or if you look at research or analysis, I mean, the overall fund management, the best fund managers in the world, right? They get around 6 to 7 ideas right out of 10, right? That's the best performance that you can get globally, right? Even, I mean, though we've done better with our existing track record, that is something that we keep as a benchmark. At least get 60 to 70% right out of the 100% that you get, and you're there, right? That is what we've been doing. But then you do have non-performers like this automobile company, which we started buying in 2021 December, and we've completely come out of the company today. Though the stock price has gone up by 25% since our initial buy, it's not it's not price we were essentially tracking, right? It's about what the company did. It said one thing and it did another thing, or it said one thing and didn't do that, or rather it never so it came up with a big bang with about a specific opportunity or a specific growth opportunity in the country, and then it died down because it kept diluting its facts about that specific growth area. So it was not sticking to it was not walking the talk. It was not sticking to what it said initially, nor was it giving us a hint on where it is going to go in the future. So we made a strategic call to come out of this company, because it is not in our interest or in our investors' interest to stay invested in such companies. So this typically what it tells you is, right, there's no one way to assess a specific company, because it can throw up different kinds of scenarios in front of you, and investment allocators have to keep their head right and in the right place before they react, right? So this is our response today to any situation that comes our way. This is not strictly in a 4 quadrant. I mean, you can still put different situations in these 4 quadrants, but then it it is extremely dependent for the capital allocator to keep a clear mind of what he's focusing on before reacting to situations. And this pretty much sums up whatever we've been doing since our inception. And this is a specific case of our value addition in action, right? So this is a company which is a household FMCG company, and this It's been so when we started buying around 150 to 160 rupees per share. We bought around 3% for our clients, right? So what has happened is this company has always been underpriced by the overall markets. But then we took wind of what is happening behind those numbers, what is happening behind those financials, and we ensured that we started buying this company at a much early stage. Today, it's in a different tangent in terms of price, but then we have stopped buying. But we have not sold this position. This overall chart tells you that even when we start buying at 150 to 160, right, we buy 3%. And when it moves up, let's say close to 220 or 230, we've reduced our initial buying position to 2%. We ensure that value. So this tells you that we are extremely value conscious, and just because the growth is going to appear, or rather the growth is going to come, we don't compromise on value on that point of time. So when people usually ask us, right, are we value investors or growth investors? We always tell them we are growth investors looking for value, right? So that's how you can typically put Solitaire in 2 words, or rather 3 words, sorry, right? So when if you look at how the after the initial upmove of 25%, when we reduce our position to 2%, close to when we bought for all our clients, when we went close to 250 rupees, right? That's when we decided to stop buying this company, because the valuations were not comfortable for us to buy for a new client at that point of time. So this is what our customization works like. It is extremely important for all our investors to feel homogeneous about their experience, and it is our duty as investment allocators to ensure that this is across the table, and it is not just for people who are early or late to the party, or so it cannot be advantageous to one and cannot be disadvantageous to the other investor, right? So we have to have a reasonable set of homogeneity across portfolios, which is why we track every position, every client portfolio, and every stock on an individual basis. So it's a client level portfolio approach that we follow across our portfolios. It's not just restricted to Solitaire. This happens across our PMS universe. And typically, long-term investment success is just this. It's to ride your winners and sell your losers. So when we say ride your winners and sell your losers, it's completely dependent on fundamentals. What we typically do is we ride our winners for a short period of time, we get out of these winners and buy a loser. So that is typically our mindset, because we believe that value can be a value trap sometimes, right? You can say that, today one company which is a winner, which has been a winning stock in your portfolio, is overvalued without taking into consideration the future prospects or the multiple expansion. You could say that I've already doubled my money. Let me get out and look at a company which has actually been going down for a while. So if a company has been actually going down for a while, you should first look at why it has been going down. So that is not a straight what to say that's not an attribute of the company going to go up in the future, right? Just because the company went down in by 25% from the top, it's not going to go up by 50% in the next uh, medium term. So that's not why. We need to understand why the company fell down in terms of price before we get into it. So this is something that we live by. We ride the winners and sell the losers. And how do we identify the losers? It's by having a strong vigil on the fundamentals of the company. And this ensures our long-term investment success. What the portfolio would look like after a few years, as we always say, you're going to have a few big winners like the top quadrant that we saw, which is an all-star company, and you're going to have multiple optimum performers, some things which are part of the second and third quadrants, and a few losers which is part of the fourth quadrant. So the portfolios are going to be a mix of these three, and you can't avoid the losers. It's the law of probability. You will have to go through losers as part of the portfolio management process. But then typically our investment, a good portion of our investments, if they are between few big winners and multiple optimum performers, we are there. And that is something that we've been doing time and again. And let's look at how we've performed on that front as well, right? So it's Solitaire's current positioning is something that, excuse me, Solitaire current positioning is something that uh, is intimately connected to India right today. See, the financialization story of India is something that is the picture. There's nothing else so describe this better than the picture. You have hundis, you have gods which are offering QR codes today, where you don't need to use the physical hundi today to put in money, right? So that is something, that is where we are today. And again, in Solitaire, if you look at how efficient players are becoming world champions is, we typically look at, like we spoke about, we look at market leaders, and not just market leaders in the domestic industry. We curate your portfolio with a set of players which are world champions in their respective industries as well. So we typically focus on those players because they invest in capabilities, right? What gives a bigger multiple to a company from the rest of the pack? It is the capability of the company that can drive it forward tomorrow. It is not P&L-led investing today. It is more of an ability-led investing that is going to make sure you're in a winning position tomorrow. So a lot of P&L investing is P&L-led investing, while they fail to look at capability and balance sheet, which is for what Solitaire typically values very, very highly. And these efficient players are going to become world champions tomorrow. And again, Make in India is something that is fueling the overall growth, the overall manufacturing setup in overall the way the world looks at India as a manufacturing hub today. It's changing, right? And let's watch the party as it unfolds. Risk positioning, it's very simple. We are conservative to moderate in terms of where we take our risk. It's ideally a very risk-adjusted portfolio, which focuses a lot on capital protection, and return expectation is between 700 to 900 bills plus the average inflation that is prevalent in India. The I thought return static matrix. Okay, this is a very interesting slide, right? See, this is something, this is what the broader index has done over a period of 30 years across different entry points, right? See, let's say you take 1999, for example, you come into the market in year one, your experience is brilliant, right? Your portfolio is up by 66%. You believe that, or rather, you have the, as humans, we always have the tendency to believe that what happens today will happen tomorrow as well. That's how we are, right? We are mostly optimistic beings, right? When that happens, you tend to believe that the market is going to offer me monies like I've never seen before. And you go into the second year and your average returns for 2 years becomes 19%. For 3 years, it becomes 6%. And over a period of time, it settles between 12 to 13%. So let's say you came in 2000, right? Your first year, you're down by 21%. Second year, your compounded returns are down by 18% and 12%. So for 3 years, you've not made any money. And for the fourth year, you recover, and overall, 4% is the CAGR that you made over 4 years. But then you can still be negative about the markets and then still get out. But then if you look at a 24-year period, you've actually compounded your money by 11%. That's something vastly different from your initial experience in 2000 when you were down by 21%, or the initial experience for the first 4 years itself, you've made only 4% CAGR, right? So it's vastly different from that experience. Well, what we try to tell you with this slide is that markets have delivered between 11 to 13% over a period of time, and that in the long term, your returns are going to get averaged out. So the expectations need to be set that way. And our investors are always of the expectations that are pretty much decent. So they've always have a decent expectation in terms of returns because they know that the markets have delivered this much, and that is something which is 700 to 900 basis points over the inflation, works to around 13 to 15%, and that is something that we would be very happy to deliver for our investors over a long term. And now we've understood what our recent expectations are, and now we can see what we have delivered, right? If you look at the performance, we've fired on all cylinders, obviously, right? Market has helped, and the markets are obviously at their highest today, and that definitely has helped. But if you look at the last 1 year performance, if you look at markets, they've done 10% while we're at 32%. This is just to say that, if you stay within the right companies, like the IT company in the first quarter that we were talking about in the matrix, even within the IT sector, we were able to get a company which did well when the overall IT sector didn't do well at all, right? So what we extremely focus on is a bottom-up approach and not the broader markets as such. If you look at 2 years, also market has done somewhere close to 7%, whereas our CAGR has been close to 22%. All this comes at a point where everything is working out, and in terms of liquidity, in terms of business and everything. So as investors, our expectations should be decent, between 700 to 900 basis points plus the average inflation rate over a period of 3 to 5 years. And whatever said and done, this performance is something that we are really proud of. And whatever bonus that we get out of our internal expectations, right? That is something which is always that we need to be happy about, right? So if we are happy with 13 to 15% return net of fees and charges from our portfolio, whereas if we perform better, it's just a bonus for the investor and for us. That we would like to make it very, very clear at this point of time. And our team for your viewing. So it starts obviously at the top, Mr. Sham. He has over 30 years of experience in the markets, and we have our fund management team, Mr. Balaji, Rohit, Rajat, and Ranjan. And we have a very, very strong research and strategy team with CFAs and CAs. And so what we typically try to do is see, it's an institution, right? It's every other idea or every other decision within the fund management or within fund management has a specific set of processes before it gets executed, right? So it's not just one person doing it or just a small set of people doing it. It's a very, very streamlined set of processes before which a specific stock or an idea ends up in your portfolio, and it is going through a different set of experts before it gets into your portfolio. And Mr. Sham Shekhar, obviously his profile, he has 3 decades of investment experience. He has been, and you would probably, I mean, there's no need of introduction itself, so you would know his approach to investing is value based and theme based. And his strengths definitely include exposure to multiple industries as a research analyst, creating large size portfolios, and investing or understanding different market cycles. The key portfolio terms for your understanding, it's a SEBI-regulated minimum amount of 50 lakhs, and there's an exit load for 3 years, and it operates out of a fixed fee model, which is on the average daily portfolio value of the fund, right, of your investment. This 1.5% per annum is calculated on the average AUM on a daily average portfolio value charged on a quarterly basis, and other expenses being at actuals. So we've come to the end of the presentation. If any questions, please go ahead. You can type out your questions in the chat box, and I'll answer them. Okay, I think we have a couple of questions already. In what way is PMS better than MF portfolio investment for 5-year plus holding, from Mr. Ravi? Okay. Hi, Mr. Ravi. Okay. So see, we do not claim that PMS is better or MF is better, but then if investors are looking for customization in their portfolios, right? What we or where we stand as PMS capital allocators, I mean, where we is advantageous to us is that today we are able to take a call on a specific idea, which is much more the way we take a specific idea in or out of your portfolio is much more flexible than what a mutual fund does, right? Because the customization that is offered by a PMS, any PMS for that matter, or the structure of a PMS is much more flexible than that of an MF. Right? MFs won't be able to give customized portfolios to the last client, right? Like yesterday, a person can come and he might have a different portfolio versus the person who comes in today. So that is not something that you can expect out of a mutual fund, right? And typically, mutual funds have a mandate to actually invest a good amount of money as soon as they get the money, right? They can never go into a cash level of maybe 40 or 50%, right? Because if they get the money here, if they get the money today, they'll have to invest it tomorrow, definitely, even if the valuations are not too lucrative for them to invest. So that way, we believe PMS can be a better investment model for investors from our perspective. But then again, if there is a comparison, there are multiple ways in which MFs also can be better than PMS, but in this way, we definitely offer more customization and the way your portfolio needs to be managed. Yeah, so that is something that we would say, though we not stick to comparisons. So that answers your question, sir. And the second question from Mr. Ravi, what is the strategy for selling of stocks frequency to control short-term CG? So our typical holding period is between 3 to 5 years, sir, or at least 3 to 4 years, right? Because our internal estimates or IRR estimates are always from a 3 to 4 year perspective, and not so we don't our first instinct is not to sell once the price goes up or anything like that. So we are not momentum traders, or we do not invest for the short term. We completely invest for the fundamentals to show up in the price, and we take a sell call when it far exceeds the intrinsic value of the company. So sometimes that can happen much sooner than we expect. Let's say we expect a company to deliver over a 3 to 4 year period, but the market already has priced in all the positives and the price is way above its fair value today. Then we take a sell call. At that point of time, the short-term CG would be inevitable, but that would be a very, very rare case. The next question from Mr. Srini: what was the average churn of the Solitaire portfolio? Solitaire predominantly works on a 15 to 20% churn, sir. So for our first client, who's 4 years old now, right? The average churn per year is between 15 to 20%. So we are typically, like we had said, a low churn portfolio, and the intention is to hold on to our winners and ensure that we extract a good amount of value out of them. So it's a low churn portfolio. It's between 15 to 20% is what you can keep on an average, sir. Question from Mr. Vijay. I have three questions. What is the AUM size, customer count, and how many stocks we would hold in Solitaire? So, okay. So the number one question, AUM is between 730 to 740 crores as of today. We should be close to 750 is what is the current AUM, and the customer count will be between 400 to 500 clients. And stocks we would hold in Solitaire, it keeps differing according to the entry point of each investor. So, but typically it's between 25 to 30 stocks that we hold on an average in Solitaire. Hope that answers your question, Vijay. Question from Mr. Srini: are there any additional fees such as profit sharing in addition to the 1.5% fixed fee? Sir, we don't charge any additional fees in Solitaire for profit sharing. It's completely a fixed fee model, 1.5%. Right? Additional fees, if you are talking about additional charges, the brokerage and the transaction charges would be on actuals, right? That is something that you would incur yourself if you manage your portfolio, right? So that is something which will be calculated on actuals. And from our experience, it's between 0.25 to 0.3% is that would be your overall brokerage transaction cost, DP charges, audit charges, and all that. So with respect to Solitaire, there's no other fees that we collect from our investors except for our 1.5% fixed fee. And the next question from Mr. Ravi: Solitaire is suitable for which type of risk? Okay, so Solitaire is definitely for someone who has a moderate risk appetite, so conservative to moderate risk appetite, because the type of risk that we take in Solitaire is way lesser than that of the markets. We have our beta, which is at 0.75, right, which is not something that you will usually hear for a multi-cap fund. They're pretty much closer to the market, right? They'll probably be 0.85 or 0.9. But then we've ensured that our beta is between 0.72 to 0.75. So it's a pretty much like a conservative to moderately conservative portfolio. And it is for investors who would want to scale up really big, because the scope is very wide. Since it's a flexi cap fund, the scope of investment is very wide. And it is for a person who has a moderate risk appetite and would want to scale up his portfolio in the future and create a wealth chest for himself, right? So that is where Solitaire sticks with respect to risk appetite. And on what basis do I need to select the PMS scheme, whether Sphere or Solitaire? My age is 51. Investment goal is for retirement. So Sphere is another wonderful product that we have. So it's a multi-asset product. So let's say you are not let's say you want a multi-asset experience, right? Let's say you don't want to put all your money into equity. Sphere is a great product for you to consider it. We buy into mutual funds, we buy into ETFs, we buy into precious metals like gold and silver, we buy into global funds, we buy into debt, all in one umbrella, right? So when you have such a multi-asset experience in terms of retirement, and if your investment goal is for retirement, you can definitely look at Sphere as a good as a product that you need to invest in, because it is specifically made for retirees. It is specifically made for people approaching retirement and for people who have not allocated much to the other side of their asset base. That is, if you are not if you do not have an idea how to allocate your overall capital into different assets, right? Sphere is a product which can do it all under one umbrella. So Solitaire is also a perfectly good product, but it's 100% equity. So whether your appetite aligns with the 100% equity product is something that you will have to take into consideration, sir. Hope that answers your question, sir. Question from Mr. Srini. I understand that Solitaire is more conservative, while Sphere focuses on small cap investments. Where can I find the specific differences to help me make a decision? So, firstly, Sphere doesn't focus just on. I mean, Sphere can have small cap investments, but it doesn't focus on small cap investments. I think you're talking about Vriddhi. Vriddhi is a small cap product. Sphere focuses on multi-asset. We buy into equity, mutual funds, ETFs, gold, silver, and global funds and debt as well. So Solitaire is moderately conservative. Sphere is also moderately conservative. The specific differences that you would need to, you can always reach out to us, because we have our dedicated investment managers who help you out with your decision, because it depends on a case-to-case basis. So if you simplistically put it, Solitaire is a 100% equity product and Sphere is a multi-cap, I mean multi-asset, and Vriddhi is a small cap. It's very simplistic in nature, right? Just talking about it with those kind of tags. It is important that we understand your requirement in a little bit more in detail. So what we would suggest is you can reach out to one of us. I'll put out the numbers at the end of this webinar, our contact numbers. You can reach out to us and we'll help you figure out where you can, or we will help you figure out where you can place your investments and to make a decision on the whole, sir. Hope that answered your question, sir. And question from Mr. Raja, what are the next steps to get started with Solitaire? Sir, I'll give our contact details at the end of this presentation so that you can take that into consideration. You can reach out to us. One of our representatives will get in touch with you to take this forward, sir. The next question from Mr. Srini. It may seem like a really silly question, but I wanted to confirm if Sham sir will be making decisions on his selection of the co-fund managers. Okay. So yes, so definitely Sham will be at the top. Sham sir is definitely at the top. He is the CIO of the firm today. So, but the only thing we would want to keep reiterating is it's an institutionally led, the decisions are always institutionally led, right? So there are research analysts, there are strategists, there are co-fund managers, and it is the overall decision that takes it. So with Sham sir and his experience, that definitely contributes to the entire decision. There's a lot of work that goes on below as well, right? With the fund management team, with the research team and the strategy team, they put in a lot of work to get the ideas out, and it ultimately ends up with Sham to take a decision on an investment before it comes into your portfolio. So with that, it's we could say that he would definitely be involved in making decisions on stock selection, but then there is a clear hierarchy that makes the ideas to the way to its top, right? It's not just a one-person company. If that is the question that you're asking, so it's a big institution today, and we have a very robust process which makes us do, or rather, which lets us take the decisions today. Right? So hope that answers your question, sir. If there are any other questions, you can type them out in the chat box. I'll be really happy to answer them. Question from Mr. Ravi. Can we view the portfolio of PMS? What is the frequency of delivering the fact sheet? So we, with respect to the frequency of reports or frequency of reporting, it's monthly, right? You would get the monthly reports, which are a comprehensive set of reports like your portfolio, performance, transaction, dividend, capital gains, and whatnot. All that delivered to your email, registered email ID on a monthly basis. So you would get them on a monthly basis in terms of those reports. With respect to viewing your portfolio, you can always log into your NSDL login to see, because this is going to be the accounts are going to be opened under your PAN number, and which would be registered under NSDL. So when you log into NSDL, you can view at the end of the day what stocks are there in your portfolio to ensure. So what we've from our end, we would be sending you monthly reports, quarterly reports, advanced tax reports, and annual audited statements as well. So that's how the reporting system is going to work. Question from Mr. Arun. Top private banks aren't performing. Is something bad about to happen like GFC has interest rates high? Also, that is something that we cannot really comment on or predict, right? See, so I mean, there's nothing as such which is bad in the immediate future that we are looking at essentially because our banking system has gotten much more stronger than it was 5 or 6 years back. There's a lot of cleanup that has happened on the balance sheet level. So how the markets react to global sentiments or global factors is something that we need to wait and see. But then with respect to where banks stand today, we believe that they're at a great place because the cleanup has happened and we are pretty positive on those as well. So, although we don't buy private banks on Solitaire, we do buy them on our other products like Sphere or True Blue. So essentially, that is not something that we would look too much into. So hope that answers your question. Any other questions? You can type them out on the chat box. Okay, if there are no other questions, I think we can conclude the meeting. Like I had said, I'll just put out the contact details. Okay, there's another question, so we'll just take that. How do you see India as a production hub for the world? Which theme you feel where India have an edge? Yes, sir. So see, production hub is again, there's a lot of opportunity that is coming from China as well. That is one thing for sure. But then, as a global economy, we are also expanding, right? There are new industries coming into the limelight. There are new avenues where a lot of business gets done today. So, with all that into perspective, India has a long way to go in terms of being a big production hub today, and it has all the ingredients, right? Like I said, a young population, a working population, which is ready to put its efforts into the betterment of the country and whatnot, right? See, there are themes that we were particularly focused on for the last 2, 3 years, like the capital goods sector or mainly the capital goods and the engineering sector, right? That is something that is delivered in terms of price as well. But then we still believe there's a long way to go. Today, we wouldn't be buyers in terms of because of valuations, we wouldn't be buyers into the capital goods industry. But then India has come way ahead in terms of digital revolution, in terms of AI. It's making a lot of good strides in the industry, and with respect to manufacturing of or rather manufacturing of commodities, we've come a long way. And these are all opportunities that need to be taken when it is to be taken, right? And India is in the position where the execution needs to happen today, and things are telling us that the execution will happen. And it is for us to see in the future, sir. So if you look at even pharma, even overall commodities, or let's say even capital goods, or even real estate for that matter, right? So, I mean, real estate is more of a local play, but then if you look at IT also, the tech revolution is something that we are moving up the value chain in terms of product because we were predominantly solution-based providers, but we are moving up the value chain in terms of IT by moving into product-based companies as well. So you can see a lot of product-based companies coming out of Chennai, Bangalore, and Mumbai. So we will have to take on, I mean, new industries can come up as well. So we will have to wait and watch where we typically execute well. The things are right, the ingredients are good. It is up to us to execute, sir. A question from Mr. Ravi. how to pay the quarterly fees of 1.5% of AUM. Will it be deducted from the investment? Yes, sir, that will be deducted from the cash balance of your portfolio. And this quarterly fees of is not the 1.5% is not the quarterly fees. It is the per annum fees which is deducted on a quarterly basis. So you'll be charged 1.5% on the average AUM for the year, but then this will be deducted on a quarterly basis, right? So this 1.5% divided by 4 will be the quarterly fee deduction from your average portfolio value during the year. So if you for the first 90 days, you'll have to so out of the 1 year of 365 days, first 90 days, it would be 1.5% divided by 4 into the 90-day average of your portfolio value. So it will be directly deducted from the cash balance in your portfolio. Hope that's clear, sir. Question from Mr. Srini. How often does the portfolio manager review and adjust the investment strategy? Sir, it's to say, I mean, if you look at our fund management process, our research process, right? It is a continuous process, right? Because we always say our idea maintenance is more important than our idea generation. Because today we generate an idea and it comes into your portfolio, it doesn't mean that the companies are not tracked or the specific ideas are not being followed or we do not attend or rather it's like we don't abandon the idea and see it bloom, right? We keep a strong vigil on companies because it is even more important to keep vigil on those companies because we've already bought the company for the client. It is something which is in the money. So more than spending, I mean, more focus is given on idea management or idea maintenance than idea generation, right? So when that happens, the process, the portfolio review or the investment strategy adjustment also happens automatically, right? With respect to idea. But we also take periodical calls depending on price. So let's say we bought a stock for your portfolio and thus that has gone up. Maybe let's say we bought it at for 5% of your portfolio because of the way the price has reacted. Let's say it has moved up to 20 or 25%. We've seen that happen in a lot of our portfolios because of specific stock firing. It becomes around 25% of our portfolio at that point of time. So to cut our risks at that point of time, so it will be a very need-based approach that we would need to follow. So let's say we won't know when the 5% becomes 25%, right? But when it becomes, we would take a need-based call to adjust your portfolio to reduce the risk on your portfolio, whether to move it to cash or move it to another investment which seems better, which seems too good to buy today, and then take a call accordingly. So there is no specific time period, though we do it every month or every day that happens. But then the intensity of this portfolio manager review, right? That is not the same across these. So daily we wouldn't be reviewing the entire list of portfolio for all our clients. And so this is something that we do. Okay, just because you brought this point, I want to bring in another set of processes that we involve in our fund management, which is today, let's say we want to buy a specific idea, we go through the entire list of clients, an entire list of portfolios, and see which idea is not available in whose portfolio, right? And then we request our relationship manager or advisors to speak to the respective clients to get money for that specific idea or set of ideas, right? This happens on a daily basis because the price is dynamic, right? The price changes every day. So if there's an opportunity that comes today, the portfolio manager will ensure that or rather the whole fund management team will communicate that to the sales team or the advisor team who will then contact the respective clients and then get the money in. So the review and the adjustment strategy is very, very need based and unique in our system. And though the usual quarterly or monthly review happens, it is completely need based because markets are definitely I mean, we need to respond to markets as soon as possible to ensure that the ideas that we want to buy in our client portfolios are bought. So this happens definitely on a very periodical basis and on a need-based basis as well, sir. So that I hope that answers your question, sir. Question from Mr. Arun. How do you see incumbents getting challenged in various sectors like paints, premium bikes? Okay. Sir, if you look at industries like you rightly said, it's not going to be just one or two players ruling the roost from now on, right? It's the smaller players also who are coming up with different kinds of offerings today. But if you look at a capital intensive industry like manufacturing, which is paints or premium bikes, right? It takes a good amount of capital for a company to come in, lay the foundation, get the distribution network up, or and make it big in that respective industry. So we typically look at some of these companies which can probably have a short term, a good run in the short term and get acquired by the bigger players, right? And it is extremely dependent on the specific industry also. If you look at paints today, the reason why a lot of, I mean, you can see a lot of players coming into the industry, right? But how will they actually challenge the bigger players is definitely a question. Tomorrow, if they're able to do the right things in terms of execution, in terms of market capturing the market, and if they have the leverage or if they have the firepower to uh, put in capital to capture it, then yes. But then that is something that we need to wait and watch. And again, premium bucks, you can see companies like Ultraviolet, which is doing a lot of things on the premium uh, bike segment on. So there are companies, there are relatively smaller companies, but tomorrow when the tide turns around, right, when there is little liquidity left in the market, will they be able to survive is a question. That time, the bigger players will be able to sustain better, right? But again, that's anybody's guess how the markets will turn out tomorrow. It can turn out to be good, turn out to be bad, but then it depends on what the time will say, sir. But today there is definitely a competition because people would want to see different things. People want to explore, not just in paints or premium bikes. It can be in consumer discretionary products or anything for that matter for that, right? So I think it's going to be an interesting period how the smaller uh, uh, David versus Goliath stories are going to turn out to be. So then I think it's going to be a very interesting period, sir. Question from Mr. Ravi. I am new to finance market. Hope PMS will give growth more than Nifty index fund. Please confirm. Sir, see, the thing is, the intention is not to beat the index, though we've comfortably beaten the index across different time periods today. The intention is to ensure that, see, Nifty again is what it's a set of skewed set of companies breaking or making the index numbers, right? Because your top 10 companies contribute to around 60% of the overall Nifty, right? So what happens is if these 10 companies move up or move down, it's going to be taking an effect on your portfolio. So the attribution is pretty skewed towards one segment. So what we ensure in Solitaire is the attribution is widely spread out across different ideas, and there is no incessant investing. There's no mindless investing that goes on. So the expectation is we will do well over a period of time, and our internal expectations are in the range of 700 to 900 basis points over an average inflation rate. Though we've done better, so expectedly we will do good. So and our investment approach is going to be not broader index performance based. It's going to be bottom up. It's going to be specific to how we manage your portfolio. It's about what you want and what we can give. If you're asking for a 15% product that will compound your money well over a period of time, then Solitaire is the right answer for you. So though we don't put ourselves against a Nifty except for the regulatory reasons at the end of the presentation, we don't necessarily compare ourselves towards the broader indices because the comparison isn't apples to apples, right? That is the reason. Hope that answers your question, sir. A question from Mr. Sweeney. I understand that you didn't invest all the money at once. Is it advisable to start now or wait for some uncertainty before beginning the investment? Ideally, we shouldn't attempt to time the market, but I'm feeling hesitant to start equity investments at near the peak. Any advice? PS, I'm not in a hurry. I want to create long-term wealth. Okay, sir. Got it, sir. So this is something that we tell all our clients, right? Even when we have a request for additional capital today, our clients understand that we buy into companies which are, see, our approach is bottom up, right? And we don't buy into companies which are too heavy in terms of valuations today. But again, whether we can rule out a correction in these stocks also tomorrow, that we definitely cannot, because that is not something that we control. Market is not something that we control. We, from our end, we can control our deployment. We can have a strong vigil on the fundamental performance of the company, but market liquidity is not something that we essentially control. So with that being said, though we do not say that these are the cheapest prices that we are buying, we are cognizant of the fact the overall market is not exactly cheap today. So which is why our initial investment is between 40 to 50%. But again, will the market correct? Will the market not correct? Or will our stocks correct? Is anybody's guess. Again, our intention is to buy these stocks at a fair valuation today. If the market gives us opportunities tomorrow, we will invest more, right? So, like you rightly said, it is futile to try to time the market. That has not worked for a lot of people as well. And I mean, as investors, we grow as we learn as we grow, right? We've also learned it the hard way that we do not, when we try to time the market, it actually backfires, right? So in the end, it's just going to be an independent approach by looking just at the valuations and where these companies are going instead of looking at the broader markets. That is our stance even today, sir. So if you ask us which is the right time to invest with us, that is any time, because we try to control what is the controllable. That is our investment approach is very gradual and it is very value focused. So we won't be buying even this 40-50% that we buy initially is not going to be into stocks that are overvalued. It is going to be into stocks that are either cheap or fairly valued today, in our opinion. And with respect to our research, with respect to what our research and strategy says, we definitely go by that approach, right? Again, so hope that answers your question, sir. Thank you, sir. Thank you. If there are any other questions, you can type them out in the chat box. Uh, so thank you all for joining us today. If there are no more questions, we can conclude. I have put out our contact details on the chat box. You can reach out to us at 9500027285 or pms at ithought.co.in for more details, and one of our representatives will get in touch with you to take this further. Thank you all for joining us today. Thank you. Thanks.